there's a lot of other people just like me that, want to do these size deals. I started by raising money from accredited investors and realized that accredited investors are not as reliable as institutions. And institutions, the problem is most deals don't pencil out because the check size is too small. Call institutions and figure out what they're looking for, and then turn around and go and find the exact deals that they're looking for and place it in front of them.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Roddrick Jones helps multifamily sponsors do larger deals by providing them with access to capital. Roddrick, welcome to the show.
Thanks for having me. Happy to be here.
Pleasure's mine. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start? Where are you now? And how did you get there?
That's a good question. So my name is Roddrick Jones. I started by wholesaling real estate, realized that I wanted to buy multifamily real estate, scaled up to start doing syndication, heard some podcasts, start, doing some syndications, realized that I didn't like owner operating, and then realized that I like raising capital and placing capital with other sponsors. Then I started raising money from institutions, creating funds, and taking those institutional capital providers' money, placing them into a fund, and investing with other sponsors.
Interesting. And is that what you guys do? I guess tell me what your business then looks like today. What does Aparti Capital Markets do?
Yeah, so basically we are a discretionary capital provider, meaning that we can act as a broker for our clients, or we can act as a direct lender and a direct investor. And so we provide sponsors with senior loans, that's bridge, that's long-term financing, and that's Freddie, Fannie, all of the, gambit of it. And then we also provide sponsors with preferred equity investments. And that's like you hear it called preferred equity or mezzanine finance. That's just the person that's after the senior lender. And we normally go up to 85% of the capital stack on that.
Okay. So when you say preferred equity, break that down for our listeners just in case they don't know. What is the difference between senior debt, preferred equity? Give us just the quick high level on that. Yeah.
So when you think of senior debt, it's just like a bank loan. So the bank is normally the person loaning you the money. They'll give you 75%, up to 75% of the capital.
Yep.
And they're the first person to get paid.
Yep.
Then if we take another step up, that's where preferred equity plays. So you have this normally called preferred equity or mezzanine financing. And the difference between preferred equity and mezzanine financing is that mezzanine places the second lien on the property, and preferred equity places a lien on the partnership. And then you have 2 types of preferred equity. You have hard preferred equity and you have soft preferred equity. Hard preferred equity looks a lot like a loan, and soft preferred equity looks a lot like, common equity or joint venture equity.
Right. And so I guess that's a really interesting, differentiation there between hard and soft preferred equity. My understanding of pref equity at this point was that it acts more like a second loan and less like actual equity. And then you're saying that there are preferred equity partners, obviously, that come in and they're more of a true equity partner in the sense that they just participate in the deal just like a regular partner would. Is that right?
Correct. And the only difference is that their upside is capped. So if they just participate in a deal like a regular partner would, you would agree to how much they get paid up front, So let's say that their return is going to be 15%. They're capped at 15%. Now, if the deal does phenomenal, they're still capped at making 15% of their money.
Who is eligible for working with partners like this? Because this is my, again, I've not ever personally used preferred equity or dealt with this side of it. So forgive my ignorance as we dig into this. But it seems like by the time you're able to bring along deals that are large enough that a preferred equity partner wants to get involved, you almost don't need them anymore. Tell me why I'm wrong.
Okay, so that is correct. So you almost don't need them anymore. That is correct. But when looking at deals, the minimum preferred equity check is about $5 million. And so if you're looking at a deal and the minimum preferred equity check is about $5 million, that means you have to be doing a deal that's at least $35 million and above.
Right.
But when it comes into play, when you're looking at returns. So let's say the senior lender stops at 65%, and then you have to go and raise, well, let's say 75 to keep it even, 75%. And then you have to go and raise 25%. Well, maybe if you layer in a preferred equity investor at 15% and they take you up in the capital stack up to 85%, now you no longer have to bring 25%. You only have to bring 15% of the equity.
Right.
And when bringing 15% of the equity, yes, that preferred equity investor gets paid on that equity. However, they may get paid a higher percentage of it or a higher portion. And then, but if you look at your common equity returns or your joint venture equity returns, those returns are higher as well. So because you're bringing a smaller check, you're bringing a smaller check to the deal and you're getting capital from another source, and that can juice your return some.
Right, because your preferred equity, and again, let's go back just to make sure I understand this right. Your preferred equity comes in, let's say you got a senior debt at 75%, your preferred equity comes in at 15%. That means you've only got 10% common equity. Now, your preferred equity might get a preferred return that's above your common equity. They may get, tell me again if I'm misunderstanding this, but they may get 8%, they may get 10%, they may get 12%, and that might be where they stop. They don't get above that. Like once they hit their 12% return, they're out of the deal. Is that right?
Correct. And most people think they get 12% all up front. So it's normally broken down into half and half. So they'll get 6. So let's say the return is 12%. Preferred equity investor writes you a term sheet. You say you get his return is 12%. Mm-hmm. It's normally a current return and there's an accrued return. Right. And so current means how much you have to pay out right now. Accrued means how much you have to pay out in the future once you close it or refinance the deal or sell the deal. So normally the current return is 6% or half. And then the accrued return is 6%, which brings them up to a total return of 12. So that way it doesn't kill the deal when, you still have to run the property and make sure your common equity investors get paid too.
Right. Now, when do you have to pay pref equity? Does it function like a preferred return in the sense that it is, it accrues, but it's not guaranteed? Or is it something where it's like a bank loan and that if you don't pay your pref equity, they're 6%, let's call it in this example, then they can foreclose. What's that look like? Yeah.
So the answer to the question is it depends, but it depends on whether you're getting hard pref or soft pref. And it also depends on what you negotiate.
Right.
And so if it's hard pref, once you don't hit so it's normally hard pref terms go after senior loan gets paid, then the preferred equity investors get paid. Right. And if you can't hit your preferred equity investor payment, then there's some rights and remedies, or there's something where some carve out where it's like, if you don't hit it, then we will foreclose on the partnership. And then once we foreclose on the partnership, then we become the sponsor and we're responsible for the senior loan.
Right.
And that's there just in case it ever happens. Do preferred equity investors want to do it? No, because they're not in the business, and we're not in the business of running properties. We're in the business of picking the right people to do their job, and help them, give them some capital so they can run with their dream. But once we become if we ever take the property back and we become the holders of it, the deal will immediately go down because we don't know how to run properties. We only know how to look at it from a financial perspective.
Right. They are in the money business, not in the running multifamily projects or properties business. I get it entirely. How did you educate yourself on this space? That's a lot of transition, wholesale to multifamily to syndications. Found out you didn't want to be an owner operator, and then you found out, hey, I can raise capital from institutions, and then you said, oh man, you know what? Even better yet, I can help broker capital from institutions to other multifamily operators. How did you educate yourself on that space, and what did you do to break in?
Yeah, so I started by listening to podcasts. I was a podcast junkie, listening to everything I could get my hands on, and then reading books. And then I actually met a guy. He was an ex-Wall Street investment banker, and he showed me the ropes. So he showed me the ropes. It was very tough love. Like, do this, and if you don't do this, don't call me again. So I'm like, okay, I'll do it, so I do it, and I get better and better at it over time. But I actually met him. I got my Series 65, and I said, okay, I'm going to take this, serious. This is what I'm doing from here on out. And so it was podcast, meeting the guy, and then bam. After that, it's School of Hard Knocks. Just going and beating your head against the pavement until you figure something out.
Gotcha. So yeah, that's the question is, I guess, how did you convince, let me ask this, how did you convince your institutional partners that, hey, I have the skill set and the wherewithal to connect you with the right people doing the right deals, and you guys will be good fits for each other? especially maybe in the sense that you didn't have a background in that space. I mean, like you said, ex-Wall Street investment banker, like that's outside of my league at this point. So how did you do it?
Yeah. So it's actually, we make it more complicated than what it is, And so when I was syndicating deals, I was doing deals between, I would say 25 and 100 million. Anyway, that's the kind of deals that I was looking at. So I'm like, hey, there's a lot of other people just like me that, want to do these size deals. And so I started by raising money from accredited investors and realized that accredited investors are not as reliable as institutions. And institutions, the problem is most deals don't pencil out because the check size is too small. And so once I realized that, I said, okay, institutions have a problem just like accredited investors have a problem. The problem with institutions, they can't find deals, check size too small. So I said, okay, let me call institutional investors and see what type of deals they're looking for. And so the first step, what I did in the past, I would go and find deals first and then present them to investors. Whereas the first step now was to call institutions and figure out what they're looking for and then turn around and go and find the exact deals that they're looking for and place it in front of them. And so in order to get in contact with the institution, they have something called an acquisitions department. So you go to the acquisitions department and you call the acquisitions associate. So the titles that you're looking for is associate, business development, VP of business development, or associate. Those two titles will get you what you need. And so you connect with them and you say, hey, my name is such and such. If you're a sponsor, you tell them you're a sponsor. If you're a broker, you tell them you're a broker. If you're an advisor, you tell them you're an advisor. So you say, hey, my name is this. I'm a capital markets advisor. We have sponsors that have need for debt and equity that exceeds what we're able to do for them. What are you guys looking for? Or what are you guys looking to place some capital so that way I can place these opportunities in front of you? And then from there, they tell you. And they tell you like in great detail too. It's just like, wow, okay, all I had to do was ask.
How do you, and I'm sorry for digging in your business here a little bit, but I think it's important for anybody that's thinking about this and even just getting a high level understanding of how these deals are put together, which everybody's got to get paid in this business. Otherwise, there's no really, there is reasons for doing it, but if we don't make money, there's probably not a lot of motivation. How did you figure out how to... Yeah, we are for profit. Absolutely. I am for eating as well. So I'm all about putting food on my table. Tell me how did you figure out how to monetize that? Like you said, okay, cool. I've got, Sam over here at the Brick Investment Group and he needs $10 million and I got this guy that wants to place $10 million. What'd you do? You say, all right, I'm going to connect you guys. And then one of y'all's got to pay me.
Correct. So in a way, yes. All right. So it's two things. So if I'm doing debt and I'm brokering debt, then yes, I will have a sponsor sign an engagement letter. And this engagement letter says, hey, you're using me to go out and find debt in the marketplace on your behalf.
Right.
And in exchange for me doing this, I'm going to charge you 1% origination fee. And then the sponsor's like, okay, I agree with that. So then once we close on a deal, then I get 1% of the loan amount.
Right.
And that's just clear as day.
Right.
But if the sponsors don't want to sign that engagement letter, I don't work. Because it's like, going to find a deal and, not getting it under contract and then going and, market it to your investors. It just doesn't work that way. If you don't have it under contract, anybody can swoop behind you and take the deal and they can, legally buy the deal. So it's the same thing with capital advisors and brokers. If you don't sign an agreement with them, they have no incentive to go out and do a deal on your behalf. Now, second half is the equity. So when we're doing equity, I'm just putting together the fund myself, and then I'm investing those funds with the sponsor. So it'll be what you call a special purpose fund or a fund of funds.
Yeah.
And so then it simplifies everything because one, in order to get paid for raising common equity or equity on behalf of a sponsor, you have to be a broker dealer. And I'm not a attorney or anything like that. So go and look it up. But you have to be a broker dealer and you have to, go through all the phases and go through all the license. So that way you can legally get paid for bringing equity to a deal.
Right.
And so the reason we do fund of funds or raise funds, because it simplifies it because one, we can raise the equity and we can invest it into the sponsor, and the sponsor only has to deal with one person, and that is us. And then from there, we get paid from the fund. The sponsor doesn't have to worry about paying additional fees or anything like that. They just pay the fund pays us.
So that's really cool. I love that you figured out a way to bring a large check, from one, maybe two investors when you just set up the fund to funds model. When you do that, how do you instill confidence in the institutional partner that, hey, you're making the right bet on the right deal?
Yeah. So the number one thing that we look for, so we look at the sponsor first, and then we look at the deal second. So it's all about people. It took me a while to realize this. Everything is based around the person. It's not based around how much you know. It's not based around if you can spit out projections. It's not based if you can tell me all the market specifics. It's based around, have you done this before? How long have you been doing it? Where have you failed? And how did you learn from that failure? And the sponsors are the people that drive that, because it's lessons that you learn in business that you'll never be able to learn in a book. It's lessons that you learn from running a property that you'll never be able to learn from a course. And the sponsor, having gone through that, been through it, then that's who the institutions are betting on the most, or that's who we're looking at the most. Then we're looking at the deal. And if the deal makes sense, then it's like a green light. But if the sponsor doesn't make sense and the deal doesn't make sense, then it's a no, But if the deal makes sense and the sponsor doesn't make sense, we can say, okay, this deal works, but we don't like the sponsor. Can you go and partner with another sponsor? So that way it'll make everybody feel more comfortable, or bring an advisor on and put the deal together that way.
Got it. Now that's an interesting point you brought up there. I guess there's one question I have on that. When you set up a fund of funds, how do you get a side letter agreement with the sponsor where they end up paying you, or do you have it set up where, like you said, you take your return straight out of the fund? And I know I'm asking a lot of questions here all at once. And if that's so, why does the deal sponsor want to go through you? Because it seems like you're diluting the returns that they could otherwise get if they just went straight to the sponsor.
Right. So that is a two-part question. So the first part is the sidecar. Yes. So the sponsor can give a sidecar or a side letter that says, hey, being that you're bringing a larger check, we will, charge you only 1%, 1% asset management fee, and we'll charge you a 1% acquisition fee instead of 2%. So basically, like, cut the fees in half. So that helps us as far as getting a better return. Getting better terms from the sponsors because we can bring a larger check.
Right. Now,
on the other side, with the funds, with the institutional investors, they can go straight to the sponsor. But at this moment, they cannot go straight to the sponsor. Why? Because we've already issued a term sheet to the sponsor. And if they were able to go straight to the sponsor would have went straight to them in the first place. Obviously, right. The sponsor doesn't know that they have the capital to place in, because most institutions don't advertise that they have capital to lend. Right. They mostly work with intermediaries. That's like instead of calling us brokers and capital brokers, they call us intermediaries. So they mostly work with intermediaries to get their capital out. And so if the sponsor can realize that, hey, I can be considered an intermediary and just be a direct investment from the firm, he can do that too. So it's all about relationships, so that they invest into our deals because they know that we have, more deals coming and we have access to sponsors. And the sponsors can go straight to the institutions and having a direct investment relationship as well. And it's just, it just depends on who you know and how you do it. Right. And that's why I said it's not about really knowledge. It's all about people. Just meet a lot of people and then you can figure stuff out. It is just crazy that you can do that.
What dollar amount for you? And I know it is all subjective, or subject to whatever it is you're working on. But for you, what is the minimum fund of funds deal you will put together?
Yeah. So the price of the deal has to be 25 million or above. That means that, you'll need a loan of 15 million and you'll need some preferred equity investments of 5 million. I think it might be 3 million. You'll need preferred equity of about 3 million. So I would say you'll need about 18 million in proceeds.
Right. Got it. So 25 million and above is where it makes sense for you to get involved with somebody. I think that's helpful as people are listening to this. If they're saying, hey, I want to get a hold of Aparti Capital Markets and figure out what, how they can help, just know that that's kind of your minimum deal size before, you guys can get involved and really help.
Yeah. But I would also say I have a heart. And that's the bad part that I don't like. I don't like that I have a heart. So my minimum is this. And, on a select deal by deal basis, I will help other people too. So if I can do it if I can introduce anybody to anybody, I'm willing to do that. If, it's the same process for doing bigger deals as it is for doing smaller deals. So I may not be able to help you with preferred equity if you have a smaller deal, but I may be able to help you with the debt, may be able to help you broker some debt out or something like that. Any way I can help, I'm going to help. But, if you have a deal and it's like, can you get this done? And it's like 25 million. I'm like, yes, I can get that done. That's easy. We do that in our sleep. But if it's other deals, we just figure it out. It's a brain game at that point.
Roddrick, tell me this. What are some things that you feel like we as deal sponsors could be doing better when we're dealing with institutional capital partners? Like when we're talking to them, what are things that we could be, just improving our game on?
Yeah, so that's a good question. So the number one thing that I see sponsors could improve on is having a pitch deck and having a one-pager. So the sponsors assume that when dealing with larger check writers that they, know the numbers and they can analyze this deal left and right, through and through. But I see a lot of deals every single day. Right. And so in order for your deal to get pushed through, you have to have at least a one-pager, a high-level overview of the deals. This is the deal. This is the executive summary. This is the team. These are our returns. This is the current NOI, performing NOI, sources, uses, exit strategy. This is, when we're looking to have this deal funded. And this is, when we plan on selling the deal. Something like that as a one-pager. And then having a pitch deck as well that explains that one-pager in great detail. And so great detail, I don't mean have 15 or 50 pages. I mean, have between 12 to 15 pages or 12 to 14 pages, something like that. And it walks through and it tells a story. This does two things. One, it shows that you're sophisticated enough and you take enough time to think through your investments. And two, it helps the investor think about the deal the way you're thinking about the deal. Because if you just send numbers over, everybody will come up with different numbers by looking at the same numbers. Right. But if you send numbers over with the story behind those numbers, then it helps people see through the lens that you wrote through. Right. Hey, I see this deal. I see exactly what he's laying out. I see that this can happen, this, and this, and it can hit these returns over this period. That's the number one thing. You don't have a pitch deck. You don't have a one pager, and you're wondering why, institutions won't call you back. If they have to think through the deal for you, then they're not going to do it because it's like, I can just do this deal. Why would I, why should I take the time to think through it if you haven't even thought through it?
Right. I love what you put there on the one pager though. And maybe of course you can look for that here in the show notes as well on the website when you come back through, if you want to go back and reread the points that Roddrick just made that should be in that one pager. I mean, those are things that it's the bottom line up front. Like this is the bottom line up front. And that I love the idea of making those two separate documents because, man, I'll be honest with you, I get really bored looking through these pitch decks that are, 15, 20 pages long. And it's like all about you and your grandmother and how much favorite you like to play golf. I don't really care. Give me the bottom line up front and I'm either going to round bid and I'll be like, hey, that's a cool deal. Let's look at that further. So I like what you said there. This has been super helpful. You've given us just an enormous amount of information on really, I think, a more nuanced side of capital raising and investing. I mean, this is not something that I think everybody has really gotten into or even understands very well. I mean, I've done this, 500 and what is this episode? I don't know what this will be, 550, 570, somewhere in that neighborhood. And I don't think we've had anybody come on the show that really talks about what you're doing today. So I certainly appreciate it. Thanks for taking the time to break this down. Are there any other thoughts or things that surround kind of your business that you feel like our listeners should know?
Yes. Number one thing is that anybody can raise capital. Anybody can anything they want to do. So one thing I want to do is dispel the myth and debunk the myth that larger deals are only for a certain select few. Larger deals are only for ex Wall Street investment bankers or ex fund managers or ex whatever. It is not true. The truth is larger deals are for people who can go out there, talk to other people, think through tough situations and the facts in front of others. If you can read, write, add, and multiply or add and subtract, you can do larger deals. Only difference is the zeros that you add behind it. And, I'm not special. I'm just another person. Anybody you talk to is just another person. We all breathe. We all bleed. We all have emotions. If you remove that and just get out of your own way, you can do anything you want to do.
Roddrick, man, preach it. I love it. Thank you so much for coming on today. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah. So number one way, you can shoot me a text message, 770-421-5160, or you can reach out to me via email, Roddrick@aparticapitalmarkets.com, or you can hit me up on LinkedIn, Roddrick Jones, Facebook, Roddrick Jones, and Instagram, Roddrick Jones.
Wonderful. We'll make sure to put all of those links there in the show notes. Roddrick, thank you so much for coming on today. I do appreciate it.
No problem. Thanks for having me.